With regards to impairment, what are the new developments under IFRS 9 and how it differs from IAS 39?
So, as I mentioned earlier, the impairment model under IAS 39 was what is referred to as an incurred loss model. In other words, you do not recognize an impairment loss until there is objective evidence that a loss has been incurred. Under IFRS 9, the concept changes from an incurred loss model to an expected loss model. In other words, you do not wait until there is objective evidence of impairment, but you basically impair and provide for impairment of a financial asset prior to objective evidence existing. The whole concept of the expected credit loss model is based on the premise that any financial asset, however secure the counterparty is, there is always a possibility, however remote, that that instrument defaults and an impairment is actually incurred at some stage in the future. Therefore, rather than waiting for any such objective evidence to exist, the entity requires impairment provisions from day one, essentially, upon initial recognition of a financial asset. However, it is important to discuss scope of the impairment requirements in IFRS 9 at the offset. So, IFRS 9's impairment provisions apply only to investments in debt securities which are classified and measured as at amortised cost or fair value through other comprehensive income. To the extent that an investment is either measured at fair value through P&L or is an investment in an equity instrument, the impairment provisions of IFRS 9 do not apply. So going back to IAS 39, one of the criticisms of IAS 39 is that even though at inception, at the stage of investing in a financial asset, there would be an expectation that there is a chance, however remote it may be, of a default taking place, an entity would recognize a return on that investment using the effective interest rate. The effective interest rate would ignore the possibility of there being any future credit losses, and when there is objective evidence of an impairment loss, of a loss event having taken place, at that stage an entity would provide for impairment. The result is what often used to be called the cliff effect, which is that you would be recognizing a constant rate of return every year, and suddenly in the year that you have objective evidence of impairment, you would have a significant charge, being the impairment charge, and from the subsequent year you continue recognizing revenue income at the same original effective interest rate. So the cliff effect was that reflection of the fact that in a given year, when there is objective evidence of an impairment, you would suddenly have a significant drop in income, and you could actually have a negative return during that year if the impairment charge exceeds any interest income you are recognizing on the instrument. So IFRS 9 turns the situation around and requires that provisions are recognized from day one. In this respect, IFRS 9 introduces what is quite a complex requirement, a model. The general model includes 3 stages and is based on a relative assessment of the credit quality of financial assets, of the counterparties to the financial assets. So the whole concept is that in stage 1 you have financial assets which, since original recognition, in other words, since the investor became a counterparty to the instrument, that since that date there hasn't been a significant increase in credit risk of the counterparty. Stage 2 has those instruments in which there has been a significant increase in credit risk since inception. However, there isn't yet any objective evidence of impairment having taken place. Stage 3, on the other hand, captures those instruments which have experienced objective evidence of impairment, and these are equivalent to where under IAS 39 we were talking about objective evidence of an impairment loss having taken place. The accounting across the different stages differs. In stage 1, an entity provides for the 12-month expected credit loss. What this is the expected losses that may take place up until maturity of the instrument. However, that probability is weighted, that eventuality is weighted by the probability of a default taking place within the next 12 months from the reporting period. The Stage 2 instruments, on the other hand, when it comes to provisioning, Stage 2 instruments attract a lifetime expected credit loss, which is the same as Stage 3. The difference between a 12-month expected credit loss and a lifetime expected credit loss is that whereas both the 12-month and the lifetime expected credit loss are an expectation of what the loss could be all the way until maturity, as I mentioned before, in the case of the 12-month expected credit loss, that is weighted by the probability of a loss event taking place only in the next 12 months, whereas in the case of the lifetime expected credit loss, the weighting is that a default event may take place at any stage between reporting date and the maturity of the instrument. There are, however, some simplifications, and the main simplification of interest to the asset management industry is perhaps that where you have an instrument where the counterparty is of low credit risk, then the entity is allowed to retain the instrument in Stage 1 without needing to make an assessment of whether there has been a significant increase in credit risk since the investment was made. In terms of low credit risk, the standard does tell us that low credit risk means that there is an expectation of low risk of default, that in the short term an entity is expected to be able to make its payments as and when they fall due, and that in the long term, if there are adverse changes in the market, in the economic scenario, that such a downturn may, but is not necessarily expected to have an impact on the ability of the counterparty to make payments as they fall due. In practice, literature around this topic suggests that any instrument which is graded at investment grade would qualify for this low credit risk simplification, and the main benefit of this simplification, as I mentioned before, is that any such instrument can be retained within Stage 1 without the need to make an assessment of whether the credit quality of the counterparty has deteriorated since the investment was originally made.
Lastly, could you briefly outline the overall impact of IFRS 9 on the investment fund industry?
It will all depend on what the fund has invested in, what it currently does under IAS 39, and what its objectives, when we're discussing the business model objective, are. To the extent that an entity currently classifies its investments as at fair value through profit or loss, either because they are held for trading or because there is an accounting mismatch with the units of the fund which may be classified as liabilities, or because the investments are managed and monitored on a fair value basis, then in each of those instances, under IFRS 9, one would expect that the entity either has to, by following the rules we discussed earlier, or would voluntarily do so, would classify the investments at fair value through profit or loss. So in terms of the measurement of those instruments, it would be expected that if under IAS 39 everything was measured at fair value through profit or loss, there shouldn't be significant change when adopting IFRS 9. That would extend also to the impairment model, in the sense that, as we discussed earlier, the impairment provisions of IFRS 9 do not apply to instruments which are classified and measured at fair value through profit or loss. On the other hand, to the extent that an entity under IFRS requirements that we had under IAS 39 classified and measured its investments under one of the other categories available for sale, loans and receivables, and held to maturity, there could be implications, and a lot will depend on what comes out of the assessment of the business model test and the assessment of the SPPI test that we discussed earlier on. So it is feasible, it is possible that an entity, a fund, would have previously classified and measured its investments under IAS 39 as at fair value through OCI or amortised cost, and it would not be allowed to continue to adopt the same classification and measurement model under IFRS 9. Like I said, it will all depend on the business model test and the SPPI test that it carries out, that is, it needs to carry out under IFRS 9. When it comes to impairment, for those instruments which are not at fair value through profit or loss, if an entity has any such instruments not at fair value through profit or loss, and this will typically include, if nothing else, any receivables and any cash and cash equivalents which are not part of the investment portfolio at fair value through profit or loss, then for such instruments there could be an impact, and a big question mark would be of how much. Specifically, a lot will depend on whether the fund would be able to apply the low credit risk simplification that we discussed earlier in respect of these financial assets. Specifically, one could keep in mind that investment grade instruments do have a much lower probability of default than other securities which are outside of the investment grade ratings, and as a result, if an entity qualifies to apply the low credit risk simplification for its other financial assets, one would expect that although there is an implication of adopting the standard because the entity would need to provide for impairment against those instruments with low 12-month probabilities of default, the amount of the provision would actually be quite small in the grand scheme of things. On the other hand, if they wouldn't be able to apply the low credit risk simplification because the counterparty credit quality is not equivalent to investment grade and the low credit risk simplification would not be able to be applied, in such instances, of course, the provision that an entity would need to make under IFRS 9 could be significantly different from what it has today from what it had under IAS 39 up until the adoption of IFRS 9.